Okay, once again, welcome everybody, and thank you for joining us today. We're excited to have you with us and looking forward to providing an update to help us all make sense of the markets. I want to tell you right up front, you'll have three presenters today from our team, Scott Duba, Eric Kraus, and I'm Matthew Eichmann, and we're scattered around the country today. So we are doing this without video cameras. From my perspective, you're fortunate that you won't have to see me, but we will miss seeing Scott and Eric's faces, and we'll certainly do everything we can to continue to make this very interactive and conversational. If you've joined us before, you know that you'll hear a great deal of practical thought leadership from Scott Duba, our Chief Investment Officer, as well as Eric Kraus, our Portfolio Manager. And one of the great things about having Scott and Eric with us is their ability to not only make sense of complicated information, but to be able to talk about it in a way that's understandable and that can mean something to each of us. So we're looking forward to our conversation today, and without further ado, let's dive into some of the information. From a starting point, as we look to set the stage and we look at current headlines, this was a little bit of a different exercise for us this quarter than it typically is. As you might recall from the last, few years, it's pretty easy to go out and find a lot of bad news. And that's not exactly how most of us want to start our day, seeking bad news, but for purposes of understanding what the current headlines look like, that's something we need to do. And normally there's a banking crisis or a financial crisis or some sort of pandemic-related crisis, or there might even be, issues involving international relations. But really what it came down to as we prepared to set the stage for our conversation today is the significant focus on what's happened with inflation. And although we'll dive into this a little bit deeper in our conversations today, we've had a fair amount of good news on that front. And as is usually the case, good news can mean good news, and good news can also mean bad news. And so one of our efforts today will be to find ways to provide you a sense of optimism so that you can find a nice path forward, but also to show you where there might be reason for caution and to help you to be in a position where you can protect yourself against potential downside. So as we get started today, Scott, I think that we're at a midway point of the year, and this is a natural time for you to look back on the market performance from the first half of the year and try to put it in context for all of our listeners. So can you get us started with that question?
Sure. Thank you, Matthew. And hello, Eric. Good to be with you guys again today. So I'd say when we just look at the first half of this year, this is one of the best starts to a year we've had in a long time. If you look at annual equity returns over the past 40 plus years, we've had some very robust growth on an annual basis. We've had some bad years, one of which was in 2022 when the market was down 25% at its worst and ended down 19%. Year to date, we're up 16%, which is one of the best first halves in a couple decades. So the story year to date is just a very good, very strong equity market recovery from last year, and that's driven by a few different things. One being the moderation in inflation, two being continued relative strength in the U.S. economy, and three being some specific strength in the large cap tech sector related to enthusiasm around the potential for artificial intelligence. If we flipped to the next slide, which shows us returns for the bond market, it's been a little bit less exciting. So last year, as we all recall, the bond market suffered its worst year really in about 40 plus years, where the bond market as measured by the U.S. aggregate market was down 17% at its worst and 13% for the full year. Year to date, we're up about 2%, which is good that it's not much worse, but it's really just clipping your coupon more or less year to date, and rates staying at the relatively elevated level at which they ended last year. When we combine these two things together, a very strong equity market and a flattish to up slightly bond market, we think about it in the context of a traditional 60-40 portfolio, which is pretty representative of a lot of our clients, you still have a really good story year to date. Matthew, if you flip to the next slide, you can see that the traditional 60-40 portfolio return is just north of 10% through June 30 at 11%. The green portion of these bars is the equity return, and the gray is the contribution from the bond portfolio. And so obviously that 10% year-to-date equity contribution is that 60% of your equity portfolio that's really driven the recovery year-to-date. We really haven't gotten much out of the bond exposure yet, but we're still clipping pretty good coupons and pretty elevated yields. So all in all, Matthew, I would say the story year-to-date has been a very resilient market in the face of higher rates, an extremely resilient U.S. economy, and a really good sort of recovery of some of the losses from last year.
And Eric, do you have any perspective on the markets from the first half of the year?
Well, I think the thing that stands out to me is just the fact that how much it's been in contrast to what the average analyst would have predicted when we started the year. You know, I took a look back at the forecasts from Bloomberg as of December 31st, what the average analyst was projecting the S&P 500 to be at. And the projected return on average was very muted with an index level of 4075, while the market's at 4,500 today. So it's just, again, I think that's part of the message today is that we don't want to get too far off sides following the groupthink or what we see on CNBC, but certainly it's been much more of a positive surprise this year for our investors to experience.
So that's helpful. It seems like it's good for us to understand that we have had a very positive first half of the year, specifically in the equities markets. It would probably be helpful for us to also have a good understanding of what's been driving that positive performance. And I think for both of you, I know we have an abundance of data to help to tell that story, but I'm going to entrust each of you with kind of helping us to work through that data and to make sense of it. So Eric, why don't we start with you?
Yeah, actually, I was on a client conversation earlier today and we were talking about this very question. And my astute client suggested that perhaps AI had actually taken over the trading algorithms and was only funding stocks that helped further its mission to take over the world. But in all seriousness, if we look at the next slide here, that has been the story, AI or artificial intelligence and that impact on large cap growth or technology companies. And a lot of data on the page here, but what we want to focus in on the top right-hand corner of the page is just that concentration in the index, the top 10 performers, and just how much of that return that they've driven. So we're now at a point, a lot of people think when they invest in the S&P 500 that they're just investing in 500 companies, perhaps even in equal weights, that you're not trying to really pick winners and losers. That's the whole premise of a passive strategy. But the reality is this is a market cap weighted structure. So companies that grow get rewarded with future dollars incrementally as more people invest in these indexes. Well, today, those top 10 holdings actually represent 31.7% of the S&P 500. And it just so happens that most of those top 10 holdings are in the technology sector, which did suffer a very severe return, severe drawdown in 2022, but has absolutely led the way this year. So just to put that in a little bit of perspective, we've talked about the S&P 500 being up around 16 to 17% year to date. But if you equal weighted all the stocks in the S&P 500, the average stock return is only about half that, about 8.75%. So it truly has been technology that's led the way for us. But if we flip to the next page, we can illustrate that just a little bit further from a valuations perspective. And this is where we want to be maybe a little bit cautious. So we look at the bottom right-hand corner of the page here, and just one very simple measure of valuation to where things stand. How expensive are stocks today? When we look at the price to earnings ratio over the 20-year history and where we sit today, this got out of hand in 2021, perhaps sold off maybe a little bit deeper than it needed to last year, depending on your perspective. But where we sit today, especially on that growth side, you see numbers like up 144%, 127%, 160% of the 20-year average. That would suggest that one of two things: either there's some exuberance that's priced in with the excitement around AI and technology investing, or perhaps you could take the other side of the coin and suggest that, hey, look, earnings over the last 12 months did go through a recession. Then maybe these numbers are just looking forward to whether we enter a recession this year or not, that ultimate recovery in 2024 and 2025 and what those corporate earnings might look like. So Scott, I'd welcome your thoughts on that too.
Yeah, I would agree. I mean, this is a telling chart, and just to reiterate the point, that bottom right-hand corner 9-square table, this is the current price to earnings ratios as a percentage of the 20-year average. So if you look at the top right corner, large cap growth is trading at 140% of the long-term average at about 19 times. It's currently at 27. Whereas, other parts of the market, such as large cap value, which is the top left, is a little bit more in line with the historical averages, around 14 times. So to sort of emphasize Eric's point, a lot of the growth in valuations this year has been concentrated in that large cap tech sector. And that's just something that we keep in mind as we think of where we go from here. I don't think many people would look at this and say that large cap growth is cheap, just given that it's trading at quite a premium to the history. But again, that how much or how to what extent it might be expensive is just going to be a function on how well these companies can grow their earnings to reflect the valuations we see today.
Yeah, one last thing I'd just jump in with there. This hasn't really gotten many headlines, at least not lately. One of the major factors that caused some of these multinational global tech companies to suffer last year was a very strong US dollar. And that trend has very sharply reversed this year. So that weakening dollar does also have an impact. And we can maybe dive into that in our next webinar, but that's something also we're tracking as a contributor to growth outperformance. So really just more of the same here, Matthew. If you want to take us on to the international markets, I think we can keep us moving.
Yeah, I think that's, it's a common exercise that we work through near the end of each year or right at the beginning of each year to try to identify whether we think it will be a strong year for US markets in relation to international markets. And I think it's probably helpful for us to look back here from the halfway point and to get a sense for, how those two have performed compared to each other. And then perhaps that'll help us to try to look forward and, maybe make some predictions about what might happen in the near future. So Scott, why don't you start us here?
Sure. So if we look at the equity market performance by region, this table on the left shows 2023 and 2022 performance by region, and then there's a 15-year average in there. U.S. S&P 500 markets are up about 17%. That compares to being down 18% last year. If you look at the all-country world ex-U.S. constituents, which is that next line down, that's up about 10% after being down 16% last year. So in general, the U.S. equity markets have been really the leader year to date in performance. There's a few countries on the bottom that have also performed quite well, but it's really been kind of a U.S.-led story. And I'd say that's a function of a couple of things. I'd say number one, the U.S. has a disproportionate share of those large cap growth technology companies that have been the real valuation beneficiaries of this excitement around AI. Secondly, I'd say from an inflation standpoint, we have seen good progress domestically in the inflation readings coming down as a result of the Fed's actions with interest rates. And third is just the underlying resilience of the U.S. economy. We'll get into this in a bit more detail, but I would say relative to some of the international economies, the U.S. economy has been quite strong. And so year to date, U.S. equity markets have, for the most part, led some of the international markets. If we flip to the next slide, what this means is that, from a valuation standpoint, there's potentially some opportunities in some of these international markets. Can you all see the next slide, Matthew?
Scott, are you looking
Matthew,
at international equity valuations?
Well, my slide didn't change, but I'll speak to it nonetheless because I can pull it up on the side. So if we look at international equity valuations, what you can see here, if you're looking at the right chart, there's a couple of squiggly lines on the left and the right. On the left, you have the PE ratio of international markets relative to U.S. markets. Can you go back one slide, Matthew? Oh no, sorry, this one's fine. So let's look on the right. So these global valuations, what this shows us is the valuations on a PE ratio basis of the U.S. market versus some of the international markets. That darker blue or purple diamond is the 2021 valuations. You can see U.S. markets were at 21 times at the end of 2021. Currently, they're at about 19 times. And that bar in the middle is the long-term average. So if you look at that U.S. Chart or that U.S. column, you can see the U.S. markets are trading above their long-term average. When we look at Japan, in Europe, and the Chinese markets, they're trading at a discount to those long-term averages. So the point here is that the U.S. markets, the outperformance year to date, the strength of the U.S. economy, the progress in inflation, that is reflected in valuations being a bit higher than international markets. And now if we flip to the next slide, which is my squiggly lines. So on the left, this is the international PE ratio relative to the U.S. on a percentage basis. So traditionally, the international markets trade at a bit of a discount to the U.S. market, typically about 16% less on a PE basis. Right now, it's at about a 33% discount. So that just sort of illustrates the point that the U.S. markets have really sort of seen a valuation expansion relative to international markets. And to us, that's something we think about in terms of opportunity for portfolio allocation. Now, given that our clients are by and large almost entirely U.S. customers and clients, we focus a lot on the U.S. markets, but we also keep an eye on opportunities in these international markets to the extent there's opportunity there.
Yeah, Scott, just one interesting point on that. It's good that we've had a home country bias, certainly for the last 15 years with U.S. markets outperforming, and that's largely what's led to this big spread in valuations. But just statistically, to know that Japan, for example, one of the major components of that developed international market index, just now broke above its 1989 all-time high. We have to take these charts and valuations with a grain of salt because the U.S. economy does appear to be maybe ahead of the game in terms of inflation tending down, but it's hard to ignore, as finance geeks, when we see things one standard deviation out of whack, that causes attention. When we see things two standard deviations out of whack, gosh, that's got to gather some attention for us to potentially allocate some capital for longer term investors, and that appears to be the situation here today.
Yeah. And if we flip to the next slide. Go ahead, Matthew.
Go ahead.
I was just going to comment, if you compare kind of the equity markets, the U.S. equity markets to the international ones, we can see internationals at a bit of a discount because the U.S. has outperformed. When we look at global bond market performance, it's been a bit more consistent. I'd say the U.S. total return year to date at 2%, more middle of the pack relative to some of the international markets. Global ex-U.S. is up 1%, so doing fine. There's a bit more variance in bond market performance year to date, really as a function of sort of inflation and interest rates in these different markets. But there's less of a pronounced outperformance in U.S. bond markets versus international.
So Eric, we saw a slide earlier from Scott that looked at the historical annual fixed income performance numbers, and we saw that 2022 was a historically rough year in the fixed income markets. We're looking right here on this slide at the global bond market, but I think for a lot of our listeners, they want to know a little bit more about the fixed income markets, specifically within the U.S. So I'm hopeful that you can kind of walk us through what's been happening within the fixed income markets in the U.S. and give us a sense for what we might see as we move forward.
Sure. Yeah, it's hard to celebrate a fixed income return of 2% when equity markets have been so robust this year, and particularly after the pain that we had to endure last year. But if we look at that chart on the next page, we can dive into some of the specific returns and yield levels for different types of U.S. securities. So kind of going right down the middle of that chart on the left-hand side, where we're looking at that 2023 year-to-date return, we can see that essentially what the return has been for bonds has been approximately what the current, half of what the 12-month yield is for these fixed income indexes. So the one that comes to mind that people most track, or what people would call the bond index, is that U.S. aggregate halfway down the page. And again, we're up 2% for the year, but our current yield on that index is 4.81%. And, again, for years, we had very little to work with in fixed income with interest rates near zero on the short end of the curve and maybe a 10-year treasury of 2%, something like that. So that's all we could expect to get for the year. And even if interest rates just kind of hold steady here for a while, which seems to be the messaging in the Federal Reserve, if we can double that over the course of the next 12 months and get a 4 to 4.5% rate of return on some of our more stable components of our investment allocation, that's not all bad. But it's also important to remember, if we go to the next slide here, that the interest rate return is just one component of what we get when we invest in bonds. So that's what's sort of reflected here. I won't go through all these in great detail, but when we look at the total potential return, the yield to worst on different types of investments, we know that when interest rates ultimately go back down, that'll also put pressure up on bond prices. And how Scott was showing the charts that maybe look just like this on equities, and we were talking about the diamonds kind of being well above the purple line, suggesting things were overvalued. These blue diamonds above the purple line suggest that the current yield that we're getting almost across all classes of fixed income are better than we've experienced in the last 10 years. So while it's not as exciting as AI and NVIDIA and 16% equity market returns, being able to get these yields while they're here, because even if the Fed doesn't cut until next year at some point, we don't think these yields are going to stay around forever. So for more conservative investors, being able to lock some of these in is pretty attractive. And as we mentioned, even in our last webinar, for people that are just looking for cash preservation, having access to Treasury bills and CDs at 5.5% is certainly a better tool than we've seen in quite some time. So in summary, not very exciting year to date, not the robust snapback V-shaped recovery perhaps that we've seen in equities, but stabilizing and moving in the right direction here.
Yeah, and one point I would make just to follow on that is that, while the short-term interest rates, the 2 years at 5%, that's, kind of a no-brainer in terms of risk-adjusted return for 2 years. I'd say the vast majority of clients are investing over 10, 15, 20-year horizons. And so if we only stay in short-term securities and we do see a recovery in rates, that's money that's going to need to be reinvested in 2 years. And so I think the point that Eric is making is that, allocating some of that portfolio to some of these longer, potentially slightly longer duration, with a little bit of credit risk aspects of the fixed income market can make sense, because you're effectively able to lock in these yields that are pretty close to the highest they've ever been. Now, obviously, a lot of that's driven by the rate environment today, but you're still getting paid both. You're getting paid both the rate, the underlying rate, and the spread.
Yeah, Scott, I think that's helpful for us to keep in mind. And obviously, there's a relationship between the rates that we're seeing, specifically on a risk-free basis, as well as what we're encountering from an inflationary perspective. And, we showed some headlines at the beginning of our talk today suggesting that we've had very good, or at least relatively good, inflation news this week. I think that leads us to this obvious question, is that all behind us? Or more specifically, has inflation been tamed? And I'd love to hear some thoughts from you guys on that question.
Sure. So I would say, to state the obvious, we've made a lot of progress over the past year in terms of inflation. A year ago, we had headline CPI in the 9% range, which is back to early 80s type levels. And we've had a tremendous improvement in that. Headline CPI was 4% in May, and just recently this week, we saw June was even lower at 3%. I think to say that inflation has been tamed, though, is a bit premature. You'll notice that the core CPI number, which strips out some of the more volatile measures, is still in that 5% range. And this is important because this is a stickier part of the inflationary complex that I think will be a little bit more difficult to tame longer term. And frankly, when we look at the inflation components on the next page, a lot of this improvement year over year is in some of those more volatile components of inflation, namely energy. We all remember, the middle of 2022, when oil markets were kind of going crazy with the Ukraine-Russia war. Oil was over $100 a barrel. It was costing us a lot to fill up our gas tanks. That's obviously calmed down a lot. Oil's now at about 70 and gas prices are a bit more normalized. As that component, that energy component has calmed down and actually gotten better year over year, that's driven a lot of the recovery and the contributors to headline CPI inflation, which is the colorful bar chart on the left. You can see back in May, June, we're at about 9%, 2 or 3% of that was energy. Now, in May of 23, and including, the print earlier this week, energy is now, it's dragging down inflation. And also just keep in mind that these are year-over-year numbers. So to put it in simple terms, if you had spent $100 in the middle of 2021, if you bought the same basket of goods in the middle of 2022, it would have been $109. Now, in the middle of 2023, you're 109 times, 1.3, 1.4%. So you're still spending $113 for what you would have bought 2 years ago. That rate of inflation has slowed, but obviously the impact on the consumer, on the client, is non-trivial. And if you look over on the right side of this page, this is the contributors to the core inflation number, that 5% figure that I think is a bit more concerning. The red piece of this is something that we've all probably experienced to the extent we've taken our families on a little vacation over the past couple months. But transportation, even excluding airfares, is still running pretty hot. Airlines have been improving a little bit, but there's not a lot of cheap air travel out there today. Recreational services, education, and other, really these service components of the economy are really the stickier parts that are probably going to keep this core number a little bit more elevated than the Feds and certainly consumers would want to see it. So, when you think about how we got here, if we flip to the next slide, we've had a tremendous amount of rate increases. I'm sure we all recall in 2020, 2021, risk-free rates were 0. The Fed funds rate was 0. We've had over 500 basis points of rate rises in the past 12 to 18 months. And obviously that's been very helpful in bringing down some of these inflation numbers. But I think what's been surprising is the resilience of the economy in the face of really unprecedented increases in risk-free rates. Now, these things take time to roll through the economy. And so it's not surprising that we haven't seen a huge impact, or at least a total impact, from these rate rises yet. But I think what has probably surprised market prognosticators and economists is just the resilience of the U.S. economy. In particular, on unemployment, if we flip to the next page, the unemployment rate, the 50-year average is about 6%. We're still pretty much near all-time lows. We're still running sub 4% unemployment. And that is keeping wage growth still relatively elevated. Now, wage growth has come down a bit over the last year. It was running about 7% last year. Now we're still at 4%. But I think this is feeding directly into some of that service sector inflation that we're still experiencing. So, to summarize, we've made a lot of progress on inflation, no doubt. Some of that, I think, is more specific to the energy markets. And I think we're probably entering the more difficult phase of this inflation taming exercise. I would say the Fed has been unequivocal thus far in their desire to see inflation back down towards their 2% target. I would argue that they've kind of done the easy part right now, getting it from 9 to 3. And I think the harder part that will test the resolve more is, how long and how high they need to keep rates to really get that 2% inflation target achieved. And thus far, the commentary from the Fed has been pretty consistent. Fed Chair Powell often references some of the former Fed chairs in the 70s and 80s, Arthur Burns in particular, who in retrospect maybe claimed victory a bit too quickly in the 70s in terms of claiming inflation. And that led to, even higher inflation in the 80s. So I think the Fed is going to keep rates at an elevated level. Obviously with the economy as strong as it is, I think there's still work to be done on inflation, and we'll see how that filters through the economy and the markets.
Yeah, I think, Scott, just to follow on to that, the market seems to be pricing in maybe one more rate hike here in July, and then perhaps more of a prolonged pause versus the hawkish pause that they gave us last month. We made some jokes about that. But the reality is those rates being held at that level, in addition to quantitative tightening, is absolutely restrictive to the economy. And you're right. I think that the market and the economy has been somewhat accommodated for the Fed's mission so far, in a way, because it's not been as politically dangerous to bring inflation down without the side impact of rising unemployment. But that will be the more difficult test, is if we do start to see that unemployment rate tick up, jobless claims start to pick up, if they do have the resolve to finish the job and get us back down to 2%.
So I think people want to know, do you feel like we're going to avoid a recession given what you know at this point in time?
That's it. Yeah, it's a great question. And I feel like this is a little bit of deja vu to the presentation we gave a year ago, because that was already on people's minds. So if we do enter a recession in the next 12 months, it will be by and large the largest or most expected recession in the history of the economy, because it's been talked about for so long, and it's not typically that easy. There's certainly different sides of the coin that you could take here, different cases that you can make for and against a recession. But the average forecast on Wall Street is still over 60% consensus yes in the next 12 months. And Scott, I'll let you review some of the data here, but you start to see some cracks in capital spending intentions, some what we call leading economic indicators. We also know that consumers are starting to get stretched. All that excess savings that was accumulated during the pandemic, that's largely been spent through. And we're starting to see household debt creep back up, credit card debt starting to creep back up at very high interest rates. So it remains to be seen, I think, how much longer that will take before it has a true drag on economic activity. But anecdotally, even speaking to our clients that are in the financial sector, talk about how lending has frozen. The commercial real estate sector still looms as a potential negative that could tip us into a recession. So far, it's been very resilient, to Scott's point. But it's also just, again, important to call back and look at history. In 2007, right before the great financial crisis, GDP in the fourth quarter was positive 2%. And unemployment, typically reaches its low points right before the recession starts. So, Scott, I'll let you kind of walk us through some of the data. I don't mean to sound too doom and gloom there. If we do have a recession, it's still not necessarily going to be the financial crisis. It could be something that's relatively short-lived, and perhaps that's what the market's seeing here. But why don't you give us your opinion?
Yeah, so I think Eric's right. It's interesting when you talk to business owners, business leaders, especially individuals that operate mid-sized regional banks. The credit markets are really tightened up, and I'd say you're not seeing that directly in the data thus far, but it certainly seems to be coming. If you look on the left side of this chart, this is profit growth year over year and capital expenditures year over year. The light blue line is your profit growth, and your gray line is your nominal capital expenditures. So nominal meaning this incorporates inflation. Year-over-year CapEx has still been pretty good year to date, running around 10% nominally, even though operating EPS has fallen a bit. But when you look on the right side, this is capital spending intentions over the 6 months. And just to state the obvious, capital spending drives a lot of economic activity. So it's an important indicator of kind of where things are headed. If you look at the regional Fed surveys, that lighter blue line on the right chart, as well as real non-residential private fixed investment year over year, these have been falling pretty steadily for a couple of years now. And so that would seem to indicate that capital spending is slowing down. And I would think largely a function of rate rises and tightness in the credit markets. And that's something that we're just keeping an eye on as an indicator of potential slowing economic growth. If we flip to the next side, what's interesting, though, is that the residential real estate market has held up incredibly well in spite of a lot higher mortgage interest rates. A lot of this has to do with inventory. If you look at housing inventory on the top left hand, this is the inventory of new and existing single-family homes for sale. There's just not a lot. It's 1.3 million, whereas the average is 2.4. This is I think the understandable element of this is a lot of people have locked in really low mortgage rates, and so there's fewer people that are trying to sell their house, because if they sell their house, they got to go out and borrow at 6.5%, 7% to buy a new house. So there's not a lot of inventory of existing homes for new households to buy. What that means is that on the top right, single-family housing starts have been very strong year to date. because that new supply has to come from somewhere. And so there's been a lot of building activity. The home builders have been very busy trying to meet this supply-demand imbalance. And you see that on the rental side too. Rental vacancy rates are still pretty low, and there's still a lot of new multifamily housing starts coming online to meet this demand. So on the industrial CapEx side, things seem to be slowing. The residential real estate, which is also a big economic driver, seems to be holding up pretty well. And then if we just think about, how's our consumer doing? We all know the U.S. economy is 70% plus consumer driven. On the next slide, what we've seen is that saving rates have fallen down a lot. There's a lot of stimulus money that went into people's pockets during 2020 and 21. A lot of that has been drawn down. Personal saving rates, which jumped tremendously during the pandemic to north of 10, 15%, about the long-term average of 9%, are now down to about 4%. The excess savings, which is in that top right-hand chart, you can see how personal savings ballooned and has been drawn down over the course of the past year. And that is kind of corroborated, easy for me to say, in the bottom right-hand corner. Revolving consumer credit cards balances are ticking back up. So people are drawing down their savings, they're starting to borrow on credit lines a little bit more. And so I'd say the consumer is a bit less healthy than she was, call it the middle of 21. So in terms of, will we enter a recession or won't we? I think to Eric's point, if we do have one, it's going to be one of the most widely expected ones in history. I would say we're definitely going to have a slowdown in economic activity, just mathematically based on some of these numbers and the rates and the credit markets. Things are going to slow. I think the bigger question is, how deep and how long that might last, and how consistently the Fed will keep rates high to try to tame inflation.
So now we get to, I think, a fun part of our conversation here today. I want to hear each of your takes on the market, but I don't want to actually hear what your preferred take is. I want to hear the best argument in favor of both a bear outlook or a bull outlook. And I'm going to surprise you by throwing it to Scott first. And I would like to hear Scott give us his impression or his perspective on the best case argument for the notion that things are going to be good and that we should be bullish about things as we move forward. So Scott, why don't you go first?
Sure. So I would say let's start at the main topic of the past 2 years, inflation. Inflation was high. The Fed has done a good job bringing it down to more reasonable levels. And one could make the argument that the Fed is actually engineering a soft landing. In spite of all the criticism, in spite of all the disbelief, thus far, this has been quite soft. It's no small feat to bring inflation down from high single digits to 3% and barely see employment even rise a bit. So inflation is on the right trajectory. The Fed has engineered a very soft landing, and what they have done is built in flexibility on their part to support the markets. So by that I mean we now have the Fed funds rate at 5 to 5.25. If we get another rate hike or two, that might be 5.5. That's a lot of dry powder for the Fed to step in if we do have weakness to support economic activity. So let's kind of roll forward 6 months. Let's say inflation isn't quite at 2%, but it's at 2.5, and the economy starts to stumble. The Fed now has 500 basis points to play with to try to keep growth strong, keep employment relatively full, and still keep inflation at a reasonably low level. And I think that the story here is that we have a tremendously dynamic and resilient U.S. economy. Business owners and consumers are adapting, and we still have, I would argue, industry leading, or rather globally leading, economic health in the U.S. That's from a macro standpoint. From a market standpoint, I would say we have reasonable valuations. I don't think you can argue that the market is cheap based on the slides you saw before in terms of where PE ratios are, especially relative to large cap growth. But this narrow rally it doesn't need to fail. We don't need to see those top 10 companies fall. But the other thing that can happen, which might happen, is this rally could just broaden out. This AI technology could really start to benefit other segments of the economy and get commercialized and really drive profit growth going forward. So I would say the bull case is things have been going quite well thus far, in spite of, everyone's views that there's no way the Fed could pull this off. So far, so good. And we could have, pretty healthy economic equity market returns from here. And bond market returns are very healthy. You're getting great yields. So, there's very good reason to stay in the market and think this rally could persist for some time.
So Eric, Scott gave us the bull case. Why don't you give us the bear case, which I think will have people in a position to be optimistic, but also remain somewhat cautious as they move forward.
Well, maybe we should just end the webinar here so we can end on a positive note. That was very well articulated, Scott, and I think there's certainly plenty of validity to that bull case, and that's why we have a market, right? People get to express opinions, and this one isn't necessarily my own, but let's give it a shot. The first argument against a continued bull market going forward is that the Federal Reserve action really has a long and variable lag before it actually impacts the economy. And if we think about 12 months ago, we were just embarking on the largest series of interest rate increases in the last 40 years. And that takes some time for that to work through into the markets, into the economy. And while we do have strength in the residential real estate market, the commercial real estate market, we all know anecdotally about all the empty office buildings that are sitting downtown in whatever big city we may be near. We also know that commercial loans refinance every 7 to 10 years and are about to do so in significant dollar amounts at rates that are nearly double what some of these real estate projects were originally financed at. So that could cause some pretty significant disruption on bank balance sheets. It could just be the tip of the iceberg in the regional banking crisis, in that you're going to see a lot of these buildings get put back to lenders, a lot of them regional lenders, that ultimately will be forced with some more consolidation in the industry. And then the further tightening in those credit conditions, what that really means is there's no money to start new projects. And if there's no money to start new projects, be it real estate or business expansion or otherwise, that's the growth engine of the US economy. And we couple all of that with the weakening consumer that Scott had noted, with the credit card balances starting to go up. So far, people are able to hang on and pay their 3% mortgages, but what about their 25% credit cards once they start seeing those unemployment numbers tick back up? So there's plenty of reasons to be cautious, and I didn't mean to sound too dramatic there, but those are the points that the bears would make, and frankly, they've been making them all year to watch the market just rip forward 15 to 16%. But I would end with the one thing that's maybe a little bit more realistic from my perspective, and that is some caution on valuation. So the market, I wouldn't suggest, is as expensive as it was during the tech bubble, or as expensive as it even was during 2021. But we are starting to see, if you're a CFO or a CEO and you just mentioned the phrase AI on your earnings call, your stock jumps precipitously. And while we do think that will be transformative for labor markets, for technology markets, all sorts of industries, perhaps the market's gotten a little bit ahead of itself from being excited about those innovations and how long they'll actually take to impact things. So the last thing I would close with there is, again, that valuation at 19 times earnings isn't cheap. It's not extremely expensive, but also when you couple that with current interest rates at 5%, that equity risk premium, or how much excess return that you're getting for taking the risk in equities, maybe isn't as strong as it would have been back in October when markets were severely depressed.
Well, Eric, I think you did a nice job with that, and I would maybe tie together Scott's comments and yours by noting something that Scott's done a nice job of explaining in the past, and that is that all of the things that Scott mentioned, which reflect generally positive sentiment as well, means that that positive sentiment is priced into the market. And so, or as Scott would say, the good is already priced into the market. So if the market slows down from its recent pace, it may not mean that things are necessarily turning terribly negative. It may mean that the positive is already priced in, which has led to some of those higher valuations that you've referenced. So again, I think you both did a nice job of helping us to understand that there is good cause for optimism as we move forward. And as always, there is good cause to be cautious and to be informed and be educated. So here's where we want to close today. So from a behavioral perspective, taking into account all the things that Scott and Eric have talked us through today, what are a couple of items that should be on the minds of all of you, whether you're a retirement plan participant or you're a private wealth investor? You're thinking about how should you be saving and how should you be investing. And here are the two things that we want you to keep in mind. Number one, the importance of saving is just as high now as it's ever been, if not higher. And unfortunately, we've seen some recent data on the other side of the COVID pandemic been a little bit disturbing or negative on a national level, and we're counting on all of you to help us turn that back in the other direction. So if you look at the bar chart in front of you here, you can see that saving reached a peak at the beginning of the COVID-19 pandemic. And one of the main reasons for that is people flat out just couldn't spend the money the way that they wanted to spend the money. And as the supply chain loosened up and they found ways to be able to spend money, whether it be on goods, whether it be on travel, that savings rate fell in 2021. And when you look at that 3% average savings rate in 2022, we know that that's not good enough. We know that that's not sustainable if we are to have a healthy future for our people as you seek to retire. So what we're asking of all of you, whether it be at an individual level or to the extent that you work within an organization and can influence others to save, we need to get that rate back up and people need to continue to save. And then when you do so, there needs to be exposure to the market. And this notion that one can time the market is not only nearly impossible, it's also very dangerous. And although there's a lot of data on this slide in front of you, I just want to walk you through a couple of the key points. So if you look over on the far left, this tells us what would happen if somebody were to have invested $10,000 in the market, let it ride for 20 years and not touch it and leave it in the S&P 500. And as you can see, that $10,000 would grow to more than $64,000. So let's say that you were a market timer and you attempted to time the market over the course of 20 years and you merely missed the 10 best days. What sort of negative impact would that have had on your account? And as you can see, you would have ended up with less than half the amount you would have had if you had left it alone. And then as you can see in the text box in the middle here, 6 of the 7 best days over the course of 20 years occurred shortly after the worst days. So the market falls sharply when it falls and it rebounds quickly, frequently when it rebounds. So again, taking these two things together, we know that we all need to be saving and preparing ourselves for the short term, the midterm, and the long term. But in the long run, whether we're in an inflationary environment or not, we'll need to have access to the market and exposure to the market with our savings amounts. So as we close today, I want to thank you again for joining us. I thank Scott and Eric for their thought leadership too, and for kind of communicating with us in a way that we can make good use of this and practically understand it. And then we hope that you'll take the opportunity to join us for upcoming webinars that we have. If you're working with retirement plans and you're a retirement plan fiduciary, we think you'll enjoy our ERISA attorney talk next week. And then the following week, we have a webinar for investors and plan participants around credit and better understanding how their credit scores work. And then following up next month in the middle of August, we will have a 15-minute webinar that takes a deeper dive on our August QPA newsletter. So again, thank you everybody for joining us. Thank you to Scott and Eric for your thought leadership, and we hope that everybody has a wonderful rest of the day. Thank you.